So I think if we look at last year specifically, we saw quite a heavy depreciation across Africa unilaterally. I think this was really as a result of decreasing foreign exchange reserves across all African countries, and inflation and other points have really started to amalgamate. I think it really tracks back to the Ukraine war around other factors. I think this year we're going to see something of a continuation, but perhaps on a slightly lesser basis. So I think if we look at 2022 for Africa, it was a difficult year. There was many challenges on the ground, namely due to factors such as Ukraine. Foreign currency reserves have been decreasing at quite an alarming rate, and this has been creating challenges such as inflation for the continent. If we're looking at 2023, we're expecting something similar, but perhaps at a lesser extent. So if we look at the decision on Friday directly affecting the continent, both Nigeria and South Africa will apply to the grey list of FATF. Now this is definitely going to create some challenges, namely with AML and compliance. So we're expecting some difficulties, particularly on the ground in these two countries going forward. So this really highlights the importance at the moment for both Nigerian and South African businesses to make sure they're working with appropriate AML and compliance orientated banking partners, and particularly for cross-border payments, I think this should be emphasized. So what we're seeing right now from the Nigerian government and the central bank is a real focus to turn Nigeria into a cashless society. Now, Nigeria is historically known as a very cash-heavy society, so this has really created some challenges and constraints on the ground. Individuals are really struggling to get their hands on the new Naira notes. Even though there's been a pushback of 60 days for the deadline, we're still seeing some real challenges on getting their hands for the people on the ground. So we're expecting this to continue, and it's delaying a lot of operations. This is most likely going to dampen domestic business operations, and this is expected to have a knock-on effect on cross-border payments and transactions for these businesses going forward.
Well, we haven't had a lot of reaction contrary to what was expected, as there was a lot of talks about this deal could potentially drop the sentiments after having a lot of negative impact of the Brexit on the UK economy. But altogether, it looks like the investors are completely foregoing the current deal that's going on and focusing more on the interest rate outcome that is expected in the coming sessions. There's plenty of data that's lying ahead, which seems to be the main focus of the investors. And as such, we haven't seen any direct impact of this deal onto the prices or on the market altogether. Well, we have a very sort of a jam-packed data sessions lying ahead of us. The mid to late part of the week is having a lot of heavyweight data, for one of them being the manufacturing PMI on the 1st of March tomorrow. That's expected to give a print of the economic numbers, the manufacturing numbers and service sector numbers of all the economies across the European Union, UK, and even America. That's potentially going to have a lot of impact on the market prices, the currency rates. All of this should build up into making a proper case for whether investors speculate seeing an interest rate further tightening, or whether they're expecting the central bank to hold any further tapering. So that's what we're having in the coming sessions, which will possibly set the tone for the coming days this week and the next week potentially.
Yeah, so the number 2 of the Fed has left a chair for a job within the US Treasury Department. She was pushing the narrative towards a soft landing for the US economy, and it's going to be interesting to see what Jerome Powell does in terms of rate hikes within the Fed, as he should be more aggressive. Well, people and investors are focused on the data, so inflation numbers, but also numbers from the job markets, especially because those are lagging in regards to what the Fed is doing. So we need at least 2 to 3 months of data to be able to draw conclusion and then expect a reaction from the Fed. which should impact yields, the FX market, and also the equity markets as a whole.